Good morning, everyone. Thank you all for coming. I'm Jason Scharfman, the managing partner of Corgentum Consulting. A few words about Corgentum, for those who don't know. We're an operational due diligence consulting firm, so we work with investors, including endowments, foundations, fund of funds, to perform operational due diligence, primarily on hedge funds, also private equity, real estate, traditional funds. We also work with operational due diligence people in those types of organizations to support their work as well. So welcome to the first of what we hope to be many such events in the coming years. I'm very honored to have a distinguished panel with me today. We'll let each of the panelists introduce themselves, and then we'll dive in and we'll save some time for questions at the end.
Good morning, everyone. My name is Luis Rodriguez. I'm Managing Director and Partner in Arden Asset Management. I'm the Head of Operational Due Diligence there. Arden is a $7 billion, traditionally fund of hedge fund shop. We also started into the world of 40 Act liquid mutual funds, which is something we're just launched a product on, and we also do customized accounts, so a little bit of everything within the traditional fund of hedge fund world.
Adam Cohen here. I serve as Head of Operational Due Diligence for Morgan Stanley Wealth Management's Alternative Investments Group. We're based in New York, a team of operational due diligence analysts, and we conduct ops due diligence on hedge funds, private equity, and real estate funds, both in the single manager arena as well as fund of funds arena for funds that are distributed by Morgan Stanley Wealth Management globally.
David Gold. I'm a senior investment consultant and head of operational due diligence at Towers Watson. Towers Watson's a global investment consultant with over $2 trillion in assets under advisement. We also have a discretionary business that has over $50 billion in assets that Towers Watson advises on. We conduct operational due diligence across all asset streams, so hedge funds, private markets, which includes private equity as well as real estate, as well as long-only bonds and long-only equities.
I'm Stephen Brown. I'm the David Loeb Professor of Finance at NYU Stern School of Business. My special area of research is hedge funds, in particular operational due diligence in the context of hedge funds.
Great. So to start off, I'd like to go back a few months and look at the events of sort of Hurricane Sandy, business continuity, disaster recovery, information technology, sort of areas that might not receive as much attention unless a disaster happens, right? So I'm curious to kind of get the panelists' take on what they saw based on the funds they reached out to when that happened. Funds were responsive and sort of, lessons learned just to start off. So whoever wants to kind of jump in.
Sure. Yeah, I can jump in. So on our platform, we have about 90 active managers that we perform ongoing operation due diligence on. And out of that stable of managers, I could say we really didn't have any significant issues, surprisingly. Business continuity, DR planning is something we tend to focus on, at least I personally like to focus on a lot. I was in a building right across from the World Trade Center during 9/11 when I worked at Deutsche Bank, and that building was not functional after that event, unfortunately. So I think the importance of DR planning and business continuity is supremely important. But after the hurricane, what was interesting, though, out of the stable of managers that we have, again, no significant problems that we experienced, actually some of the service providers of our managers had some issues. So some fund administrators, some outsourced consultant groups where DR planning and BCP is outsourced to, they actually had problems, which is a little bit more concerning to me because, you outsource with the hopes that these firms could mitigate those types of problems, which unfortunately in some instances that didn't happen. So I think although we do perform due diligence on key service providers as well, I think we need to do a little bit more. But that was really the big observation that I had from my perspective.
Yeah, I'd agree. I mean, we surveyed a lot of the managers that are in the New York area as well, and that we utilize. And most of the issues, as you pointed out, were sort of non-existent. Most groups had generators and were able to have key staff, and some groups had hot sites that they were able to utilize. But I think, as as you pointed out, there were some service providers that did have some issues. We heard of a couple of situations where managers were trying to get in touch with legal counsel or trying to finalize some documentation pieces that just took a little bit longer because of that. But we didn't have any valuation issues or other key risks as a result. Some groups, though, did indicate that they wanted to strengthen their business continuity and disaster recovery planning as a result. So maybe adding second sets of redundancies. We heard one group that was on sort of the old copper switches, so to speak, in downtown, and their phones failed, and their backup phones didn't work either, so they were using mobile, but they sort of were able to sort that out. But they indicated that they might move a second set of phones to voice over IP, which could help them. So it wasn't really a big issue, though.
I would generally concur with that. Our stable of managers, I think, maybe surprised a little bit on the upside. Obviously, when one conducts operational due diligence, one asks about business continuity, can sometimes be seen as a hypothetical topic, in my perception, from the manager's side. But that said, we got very good response rates. I think what may have helped things slightly at this point for managers of predominantly traded New York Stock Exchange stocks is that the exchange was closed for a day. So I think that did kind of help those managers active in equities.
Great.
My research has not touched on any of these issues, but although I just completed a consulting project for the Italian government where we looked at compliance with climate control issues, and failure to comply with basic issues like that was a red flag for operational issues more generally. And so that was something one should look for in terms of, although that's not quite exactly related to the business we're concerned with, the fact that if the firm is facing operational issues on a broader scale, it can lead to problems. It suggests there may be problems with their core.
Yeah, I think that's a really good point, right? That exactly as maybe Adam pointed out, and see, it's easy to sort of ignore business continuity unless something happens, right? But it's certainly an indicator. Right. I think we'd all agree if
Absolutely.
They're not planning from a business continuity perspective that they might have issues elsewhere, right? It's sort of a endemic flag of that effect. Just to follow up to that, sort of, when 9/11 happened, right, one of the issues with offsite centers in, Secaucus or in the New York area was everyone claimed to have seats in these locations, but when they all rushed there, everyone was rushing at once, right? So I'm curious to hear the panel's opinion on sort of the increased use of cloud computing and how that has sort of played into perhaps people being more prepared for these types of events where the cloud several years ago was viewed as sort of a scary thing and people were afraid of putting their data there, that type of stuff. Whoever, Adam, you want to start that off? Or?
Well, I think, I'm sure the other panelists will have something to say, but the rise of cloud computing, remote access, et cetera, is, I think, definitely something we need to look at from the data security perspective. There's obviously a trade-off there, or there could be a trade-off there, and I think we need to be concerned about data security. I think, to give the example, Morgan Stanley, we are not a fund of funds, so we really don't have one investment going into a manager. We may have clients whose individual data, address data, name data goes to the underlying managers, where we would like to see a high degree of data security in terms of who can access devices, passwords around devices, remote access, and the process for authorizing people and deauthorizing people for remote access. So I think more generally speaking, cloud computing, remote access brings into play a whole range of issues relating to data security.
Yeah, I think that's a good point. It seems that, for every solution you have, there's always issues behind that or risks behind that, so no solution is ever perfect. I'm not a technologist, but at my firm we have a very good, head of IT who we try to sit with on a quarterly basis, and my team pretty much peppers them with all types of questions on what should we be asking managers, and we've developed a template that we now send to all our managers on a periodic basis, asking all these questions because technology just changes so rapidly these days. But the whole concept of cloud computing, again, to your point, there's just a host of issues, and at least from the managers that I deal with, not all of them are fully on board yet with the concept of cloud computing. Access and the strength of the provider, whether you're on a public cloud or private cloud or a hybrid of that, really depends. So there's a lot of nuances that need to be learned. But I think the general consensus from managers I've spoken to is that it is a good solution, but it also comes with costs. So there's a lot of little issues behind the whole concept that I think still need to be borne out. And I think the concept in and of itself is a good one. But as you raised, there's a lot of issues behind that, and a lot of issues in terms of access, and what if your cloud provider goes down. Again, a lot of issues that need to be, I think, borne out over time.
Yeah, I echo the sentiments. I mean, there's nothing really to add. I would say that controls reports, so SSA 16 reports, particularly in the area of systems, are a little bit more useful in terms of understanding maybe some of the tests around employees that leave and granting permissions and revoking permissions. But there's nothing really to add. I mean, cloud computing is certainly something that's going to become more important in understanding the controls and a lot of the processes around engaging a cloud provider are certainly important. You want to make sure that the manager assesses this aspect of their business continuity planning the same way that they'd assess other things, and that it's a controlled process that is well vetted.
Yeah, and I think touches on a really good point, right, about information security. I think that's a issue that can go ignored a lot, right, in terms of do you have business continuity, do you have technology, but I'm sure the panels would agree, and if you have anything to add about asking if people have the ability to use remote storage devices, right, or zip drives, and I think many people would be surprised if they asked that question of their fund managers, what the responses might be, right? I'm sure.
So we had one manager just recently in the long-only space that actually brought a Mac computer into the conference room, and it turned out it was his personal device, and he was emailing things to his office, and we sort of called him out on that rather quickly, and the head of IT was in there, and hopefully we didn't get the guy in significant trouble, but I don't think they were too happy about that.
Yeah, it's interesting because that's a very good point. I think when you're talking about investor information, confidentiality, as well as your own proprietary information and performance data and investment information, there's a lot that kind of travels throughout the scope of the firm that you wouldn't think of. And I remember, as I mentioned earlier, we tend to talk to our CTO on a periodic basis. And, he raised some very good questions for us, which we incorporated into our template. One of them being, how do you get rid of hard drives? Do you just kind of toss them in a bin somewhere, or do you destroy them? Do you have a mechanism for getting rid of these things, because there's always stored data there? Even copy machines. Copy machines have a database where there's stored information. And I think these are things that perhaps smaller managers who are not as sophisticated really think about, and you're really making yourself susceptible to information going to places where you don't want it to go. So a lot of these concepts are important for managers to look at. And if they don't have the internal resources from our perspective, from an ODD perspective, we would at least want to know if they're outsourcing that to a good provider that could provide these types of solutions for confidentiality and information retrieval and things like that. Because a lot of these little details sometimes go unnoticed or not even thought of.
I would like to add just one little comment. I started my career at a place called Bell Laboratories out in New Jersey, and I was working with people who were at that time developing Unix and the Internet. And I was speaking to one of the great men in this area, and he said that computer security is an oxymoron. And the best practice for computer security is to just assume that the world can read everything that's on your computer.
Yeah, I think it's true, right? People
just ask the SEC, right?
Yeah, right. Ask the SEC, exactly. That's a good point. I think I would leave that there.
There's evolution away from tape drives as well, right? Which is something that we've seen a lot over the last several years. Is just people using tape backup and cloud and other mechanisms help mitigate that risk. But like everybody said, there's more risks that come up, so it's always evolving.
Yeah, and a lot of those tapes, unfortunately, are still out there, living in people's houses, unfortunately, right? So.
But they're encrypted, right?
Yeah, right. They're all protected. Talking about the SEC and regulation, maybe to switch gears a little bit, the past 2 years, at least at a minimum, have seen a lot of changes in terms of regulation in the U.S., overseas, AIFMD. In general, if you could kind of comment on the impact that you're seeing that have at funds and sort of what you've noticed, initially in terms of increased compliance personnel, more time dedicated to that in ODD meetings, how you're sort of wrangling with that from an ODD perspective.
Well, first and foremost, we talked a bit about questionnaires. I think that's something that we believe in receiving a set of information from managers as sort of the baseline, and then testing that as much as possible. But one of the things I think that has evolved is sort of the due diligence questionnaire that we utilize, and it's sort of a living document, particularly when it comes to areas like compliance and looking at updated regulatory changes. So whether it's AIFMD, FATCA, Dodd-Frank, central clearing, so on and so forth, I think trying to get a good understanding of the landscape is a critical component of the research, because we don't want to have managers that are exposed to risk for things that are obvious and in the press, and also supported by legal support. So from our perspective, I think understanding the risks, the timelines, the amount of work that's undertaken, I think are some of the key considerations. But taking it a step further, I think testing some of these things and figuring out what part might be outsourced to, say, the administrator, such as identifying the type of client that the manager is going to be using, or whether it's looking at other aspects of the regulation, such as central clearing, and how they tend to move under the exemptions of, for CFTC exemptions, or other aspects of adjusting their collateral arrangements.
Yeah, I think if you're willing to accept the risk, great times to be a chief compliance officer. The world's your oyster at this point. But there's a whole host of things going on out there in terms of things that we're focused on. You touched on a lot of them, but one of the big concerns that I have that we've been speaking to managers about is the whole concept of Dodd-Frank and complying with Dodd-Frank for ISDA counterparties. This is something that I've been involved in, on behalf of my firm, since some of our funds have ISDA agreements. And really, it's really a complex environment. And there's deadlines, there's ISDA protocols you have to adhere to, there's a CICI identifier numbers you have to get from the CFTC. There's a whole host of addendums and protocols that have to be adhered to in order to get yourself on a platform to start central clearing. You have to pick a central clearer, you have to pick an FCM, a whole range of things, and the deadlines are looming depending on what category of ISDA counterparty player you are. There's deadlines that are looming towards June, I think, is one of the final deadlines. But there's a lot of complexity there that I think managers always seem to kind of wait for the last minute on a lot of things, whether it's FATCA or this Dodd-Frank issue. And then when it kind of looms a month or two before, people start realizing, oh my God, I have to get this thing done. So we've been focusing a lot of our managers on where they stand with that documentation to the extent possible, trying to get proof that they're doing these things, and some of it is easier to get than others. But the main operational risk that we're seeing here, if a lot of this stuff is not complied with by the deadlines, you basically can't trade swaps. So you can imagine what kind of operational and investment risk that's going to pose if someone's going to get shut out from trading swaps at the very last minute if they don't adhere to all of these different Dodd-Frank requirements. So that's been one area of focus that we've really been trying to spend some time on.
I think it's still worth, insider trading, probably yesterday's news at this point, but I think it's still worth asking all one single managers about insider trading and controls in place relating to expert networks. A lot of this, I have to say, I think the SEC has been reasonably transparent in that there have been public fora in which the SEC's representatives have stated what they would regard as best practice when it comes to expert networks. There was a significant amount in the press on that about a year ago. Another area where we really haven't seen a shoe drop at this point, but for those of you who conduct operational due diligence on private equity managers, again, and who monitor the press, I think you will have noticed that the SEC has been out there on several occasions saying that they're paying close scrutiny to valuations within the private equity space and compliance-related matters. I think the ante in the private equity space has been upped significantly, given that many private equity managers had to register last year, whereas previously that was not the case. We've seen an according upping of the compliance efforts and improvement in compliance efforts all around and hiring of compliance staff after that. But one does feel that things are not to the standard that they are on the hedge fund side.
And sorry.
Go ahead.
I was just going to say, just to add, we ran some statistics from the SEC's website on where they've been sort of spending their time in terms of penalties and disgorgements, and we found that on insider trading, there's been probably 30 to 50 or so cases that they've had enforcement actions on, whereas investment advisors since 2007 have increased significantly, in fact more than 180%. So you can see that they've also tripled their revenues in both penalties and disgorgement. So the SEC is very active at the moment with investment advisors and investment managers, as opposed to sort of the headlines that we see in insider trading and MNPI.
I'd like to take a slightly different perspective here. I think the failure to comply with required disclosure is certainly a red flag for any reasonable, and the costs of compliance are increasing. I see a danger here that a lot of investors will take comfort in the new PF disclosures and the ADV disclosures. But to rely on, as an investor, on those disclosures is like relying on the kindness of strangers. There's no substitute for actually having a competent operational due diligence consulting firm do the work. You can't rely on the SEC to do that for you. So that from the investor's point of view, I'm not sure that the new regulatory regimes are going to add very much from that perspective. But there's one issue that I'd like to address, and you raised the issue right at the start of your comments, and how the central role that you saw was receiving information and testing that information. And one of the interesting issues is when your inside information differs from the disclosed information. That's a very big red flag.
Yeah. So Jobs Act, for example, would raise that, right? If a manager publicly states something, but they supply something that's different in Form PF?
Another example is with Madoff, his reported assets under management was $17 billion. Yet PricewaterhouseCoopers, who was the auditor of most of the feeder funds, if you add up all of the assets under management by the feeder funds, went to about 30 billion. So that there was a material disconnect between what Madoff told the SEC and what he was telling Pricewaterhouse, and that was clearly a very bad red flag.
And I think that also raises a good point about the new whistleblower laws, right? So you could argue that there's an incentive for certain investors, forget about investing in a fund where they have a disconnect of information, right? But actually reporting it to the government with an increased incentive that they could recover some of the damage that they're looking for. And it's also interesting, right? And we could talk about insider trading a little bit, how the SEC is increasingly roping in the FBI, right, and other type of criminal prosecution agencies that normally weren't involved in that type of work before. So it's very interesting to me to hear how settlements are increasing, right, and there's a lot of statistics about that, but the aggressiveness of certain prosecutions is clearly increasing also. So I'm just curious to see we've even seen firms, hedge funds, for example, who hire third-party firms to perform sweeps of electronic surveillance of bugs, right, in there, which sounds ridiculous, perhaps a few years ago, right? But I see some of the other panelists nodding their heads. So, yeah, sure.
One other issue I wanted to raise. We were talking a lot about SEC compliance and regulation. Just before the financial crisis, I testified before Congress on hedge funds, and I was invited in by the IRS. And the IRS, just before the crisis, was proposing a major new initiative to increase compliance and information disclosure for their purposes. And that was stymied by the by the financial crisis. But I would think that they're going to come back into that game very, very aggressively, and they're going to go to places the SEC never went.
Yeah, and that dovetails into FATCA as well.
Absolutely.
Right, yeah. And I'm sure panelists probably have similar experiences. We'll speak to many managers who sort of say, yeah, what is FATCA? Do I have to deal with that? Who's handling that? Can my administrator handle that, right? So if anyone has any other comments.
That's definitely true. I think, again, one of kind of the troubling trends is that anytime you bring up one of these subjects, whether it's FATCA, Form PF reporting, we tend to hear a lot about the administrators. I'm getting a little concerned that a lot of stuff is being delegated to the administrators, where the administrators aren't really fully prepared from the perspective of technology, personnel, and so forth, and expertise. So that's somewhat of a troubling, I think, trend that we're seeing, especially among, again, smaller firms that don't have the resources. There's a tremendous reliance, I don't know if you guys are seeing this as well, but reliance on administrators where perhaps, again, they may not be able to fill the role. Have you guys
I mean, I see FATCA as sort of dovetailing the KYC AML process, so it will reside mostly with the administrator, but the manager still has to do the work. They still have to have the checks in place to make sure that they are vetting clients appropriately as well through tax identification forms, LexisNexis checks, whatever it is that they sort of need to do to accomplish that. But they should shadow it to some extent, and they should provide documentation and show you that they are doing the work, whether it's their compliance officer or someone who is dealing with the onboarding of clients.
Yeah, I think the complexity there, and maybe the administrator in this case can help in terms of determining who your ultimate investors are, whether you have the proper IRS agreements between yourselves and that ultimate investor. So I think trying to decipher your true investor base on a look-through basis, piercing the veil, so to speak, is one of the challenges. And yeah, to your point, that's going to be work between the manager and the administrator, because as holder of the shareholder registry, whoever that will be or is, they're going to have the closest, I think, insight into the true investor base.
So while we're talking about one of my favorite subjects, fund administration, right? Talking about fees, the administration fees, they're not doing all this for free, right? So they're charging a lot more for these services. I'm curious to see how much insight you're getting from managers on that, and also if you're increasing, I know you are, but the types of due diligence you're performing on these administrators, either on-site visits, more frequent communication. I'm sorry, question? Yeah.
Can you also follow on the use of shadow administrators?
Sure. Yeah, we can add that as well. So it's a big question, but whoever wants to kick it off.
I think we spend a lot of time trying to understand expenses in general, whether it's fund-related expenses, research expenses, soft dollars, brokerage commissions. Part of our analysis is sort of focused on alpha share. So I'll sort of move over to the investment side, or just touch on the investment side of it a little bit, because that's how we define that work. But basically, we want to know at the end of the day, relative to market exposures, regression analysis, as well as ex-ante assumptions, how much alpha we're paying away to the investment manager for the investment opportunity. And that work leads us to cover things like cost for administrators, brokerage expense, other pass-through expenses that maybe go above and beyond sort of the capped expense rate. And for us, that's just part of the whole package. So we look at it to the extent possible, but we're not just focused on whether or not the manager's paying 6 basis points or 9 basis points for fund administration, but what that leads to as sort of a whole expense package.
Yeah, we've been trying to do more in terms of trying to understand, obviously, the pass-through of expenses. And, it's kind of a moving target, because for every manager who's willing to tell you something, there's the other one that kind of says, well, let's move on to the next subject. It's, some of them cite, the old, we're not allowed to tell you, confidentiality between the service providers, but you can do a little digging and eventually find out. And then again, what makes it tough is obviously how big you are in terms of the the fish in the pond. If you're a big fish in the pond, sometimes these things may come free. Other times you're going to obviously pay for it if you're a smaller player, and the administrator is going to charge you depending on what the service is and how much they're doing, obviously. A simple transparency report for some bigger manager might be free, where A smaller manager may have to pay a few extra basis points for that type of service. But again, I think just going back to the point of looking at the expertise on some of these things in terms of Form PF reporting and aggregation of data for Form PF reporting, and the difficulty of that, because having seen a template, it's not an easy exercise. So delegating that away is a tough thing, and I can imagine things like that are going to raise expenses quite a bit as it becomes kind of more of an ongoing reporting requirement.
Sure.
I'd just like to, since you are raising the issue of expenses, I think the concentration on the expenses is very good, but I think you need to look at the return that you get from making those expenses. I think that's an issue that we in this area of operational due diligence have to face. This is an expensive operation, and I think up to this point in time, many people have seen this as operational due diligence itself as a cost center, whereas in my research I tend to think of it as a profit center. That it's not the cost center that sort of obliges you to as a cost of doing business. It's rather that that appropriate due diligence can add value to the extent, in my research, of 260 basis points per year return. And I think that needs to be, you have to think, when you're talking about expenses, you should really be thinking about expenses leading to additional return. And do they or do they not? And that's the critical issue, I think.
Speaking to an operational due diligence audience, I think we all appreciate and commend that research. Very helpful in this regard. Yeah, no, definitely, right? That's one of the key points at the end of the day in terms of how you balance that out. And going back to the point of shadow administration, right? I think it was well publicized that Bridgewater, for example, recently started using basically double administrators. And for a large firm to do that, is that perhaps representative of a trend? Do you think that that's something that you're going to see more often, or is that just the more layers, the better type thing? I mean, ultimately, the investors pay for that, right? So
yeah, I think for most, Bridgewater is one of the biggest, hedge funds in the world. It's probably cost prohibitive for most others to do something similar. And as an investor, I don't know if I would be willing to pay that extra layer of fees to have redundancy on redundancy, even though it sounds good. So sets of eyes on sets of eyes. But from our perspective, what we look for and always have looked for is an internal redundancy as opposed to an outsourced redundancy. Having a qualified team of finance or accounting experts that are overseeing what the fund administrator is doing and have a proper tie-off, a proper approval of the NAV, a proper overview of the valuation process. And I think as long as you have that independent role internally over the fund administrator, I think that generally leads to sound controls. You don't necessarily have to have your own expensive exotic general ledger platform, but as long as you're shadowing internally, I think for the most part that seems to serve the purpose.
Well, in my own work, I've discovered that the most significant red flag is when you find discrepancies between different authorities. And so I think that might be an argument in favor of a shadow administrator. If you generate discrepancies in reporting, that's a very clear sign that something's wrong.
Yeah, and that's also one of the areas, right, that it's difficult to get transparency in terms of the valuation bandwidth, for example, or flexibility an administrator has in pricing certain securities. Ultimately, you could say perhaps who cares as long as it's within a predefined valuation bandwidth, but even getting that type of information, right, can be very difficult.
Yeah, I mean, I'm not as familiar with the term sort of shadow administrator. I mean, there's two elements that I would look at. The first is sort of outsourced operations, and then which could sort of be all along the lines of Bridgewater, and a lot of the investment banks have gone down that path as well, where they're focused on just exceptions-based work. If there are issues that arise throughout the valuation process, the daily recs, trade reconciliations, they then would elevate that back to the manager, who should have a team in place to sort of look at that. The other element, I guess, is sort of this idea of having a third party come in and sort of maybe price some of the positions where there are discrepancies. Perhaps that's embedded in the policy or the pricing policies that the manager has in place with the administrator, or perhaps it's done through other mechanisms that are a bit more consistent and somehow recorded somewhere so that you can actually test it. But I'm as familiar with sort of the concept of a shadow administrator per
I
se.
think in terms of Bridgewater, I think, we have to be careful in the sense that as great as it sounds, and it's mainly a way of appeasing investors or the due diligence community, it's also a focus on cost. I mean, they have a huge operations team that costs probably a lot more money than paying another administrator. So you have to look at that. So what's really the true reason behind doing that is to eliminate a big cost center internally, or
But
is
that
it-
goes
or
from
is
a
it really-
management expense to a fund expense, right? Who cares if they've got a big cost and they're able to support it as a business? That's their kind of decision.
It depends on where they're passing that through. But I think whenever it's been in my experience having worked big banks, whenever you kind of move something away to save money, 2 years later it comes back because you lose control. It happens all the time. I've seen it in my career in 20 years in every big bank. Let's outsource it or let's move it to India, somewhere else. And it's back and it's more expensive 2 years later. So I'm not fully on board with the concept.
Sure.
I'd like to second what Lewis has said on that. I think you need to, in any of those situations, you need to assess the manager's internal capability. As has been mentioned, there can be a range of resources that they're using to track the NAV. They may be shadowing the NAV internally. They may not be. We've seen the odd situation where managers will do some sort of outsourcing of the back office where, for the size of organization they are and the level of resources they can afford, that may be a good decision, whereas for another type of organization, that may not be the best. I think we should also, it's worth distinguishing between hedge funds and funds that trade in liquid assets and easily priced assets versus private equity. Right. Private equity at this point, although there is a trend towards external administration, many funds can be internally administered. And that's where we do see use of valuation agents. Is that one would assess there the benefit that brings to the overall fund administration and NAV process.
And also with private equity, right? Remember, they're paid on committed capital and they're paid on exit value. So whether they mark the position up or down in between is not as material, but you obviously want to test the exit value versus the mark value and what the sort of delta is between those two to get a sense of if their books and records are accurately kept.
Right. In my work, I looked at 440 operational due diligence reports and discovered that there was a 25 to 30% discrepancy between manager's NAV and the administrator's NAV for the same fund. And so there is an issue here, and checking it is a really important issue.
Right, which is even more an issue when they're self-administered. Right?
Exactly.
Potentially
In
private
fact,
equity.
that was when there was a big discrepancy and they were self-administered.
Right.
That was a very strong predictor of failure.
In my view, though, I mean, there's a big difference between self-administration on a hedge fund and self-administration on a private equity
Correct.
firm. So I just want
Correct.
to make that clear.
Correct.
Yeah, and I also think, right, that the lines are becoming somewhat blurry, right, with more hedge funds holding more liquid positions or vice versa. Just following up on private equity for a minute, there's a big debate, right, or several years ago, of should I even perform operational due diligence on private equity? And then, okay, everyone sort of says I should do that now. What's the benefit to doing that, or sort of, ongoing work, as you said, if it really only matters in the exit value? I certainly have my own opinions. I'm just curious if what you're seeing on there, or Adam, maybe you mentioned some of that stuff.
Yeah, I'll kick that off. I mean, we cover a lot of funds of funds in addition to single manager funds. So we cover numerous private equity and real estate funds of funds that invest in private equity funds. So to some extent, we have reasonably good visibility into the trend amongst private equity funds of funds. And what I would say over the last 2 to 3 years, we've perceived a definite increase in their operational due diligence efforts pertaining to private equity funds. May not be exactly the same process that's been performed on hedge funds, may not always involve an operational due diligence on-site. It may be a conference call instead of an on-site. It may be centered around a due diligence questionnaire. But I think the general trend is towards more in that space. I think the traditional, response, well, why should we perform ops due diligence on private equity, because once we're in, there's nothing we can really do about it, I think has kind of fallen by the wayside. I mean, there's a lot of work you can do up front that is perhaps as relevant on the hedge fund side, background checks, cash controls, etc. I don't think there's a good reason why you shouldn't be looking at that up front, and on an ongoing basis as well. I mean, the headline risk is still there. The question remains, what could one do, particularly if one's beyond the investment period and all investors' capital has been called. But some of these private equity managers, often have follow-on funds that they're in the market with prior to the end of the previous fund's term. And I think, before re-upping, one would certainly want to take a look at, would be informed as to operational due diligence matters.
Yeah, I agree. I mean, we do work on operational due diligence on private equity managers, and I think from our standpoint, there's a lot of room for slippage, particularly when it comes to consulting fees as well as servicers that the private equity manager might use, and that might be more applicable to real estate, but the understanding of the entire framework for sort of the flow of expenses, capital calls, distributions, the actual flow of capital, as well as where expenses are sort of born and who bears those expenses, and if there's sort of a share back to the fund is sort of a critical component to understand. But it's always there's always sort of that generational lag, right? So if you're already in private equity, right, you're not going to want to go into the house or to an investment with just a flashlight, right? You're going to want to flip the switches on. So you're going to want to make sure that you've done the investment work as well as the operational work, regardless of the asset class. And in private equity, it probably is a little bit less about valuations and more about capital flows. But from our standpoint, I think there's always that generation lag because you sort of step into something where clients are exposed to the fund. But, as you pointed out, there are next generation funds. There are other vehicles that are launched by the private equity manager. And you want to make sure that all of their operational areas and controls and procedures that they follow are sort of a best practice.
Speaking of someone who's not that familiar with private equity management, is there not the issue of fraud protection?
That's a huge issue.
Even if you're invested in the fund, you still have a fiduciary responsibility to ensure that fraud is not occurring.
One thing I'll add, and this is a comment I made to some people earlier as well, in private equity, there's general bias, right? Because there hasn't been a Madoff type event in private equity, so people think, and there hasn't. But private equity fraud still exists. People just don't talk about it. Right?
They set up consulting companies, and they sort of it sits side by side, and that consulting company is getting paid, which is a fund expense. So that's technically theft, right?
But and maybe to hear what the panelists have to say about this. Try approaching a GP of a private equity fund as opposed to a management company of a hedge fund and saying you're going to do operational due diligence, right? You probably get two different responses.
Very hard.
Yeah.
Yeah, although again, with the increasing trend, I think as an operational due diligence professional that maybe has a bit of oversight over private equity in one's own book, I think the extent that the market is moving and that other operational due diligence professionals are going in and doing operational due diligence, perhaps it ups the bar as far as yourself is concerned to go out there and do operational due diligence as well. Let's say everyone doing operational due diligence on a private equity manager, which has not had operational due diligence before, is deciding not to invest because of some significant negative factor which they've uncovered. I think as increasingly more start doing that in the private equity space, I can't see why one would want to be too far behind that trend. The fraud protection I agree with. Often when conducting operational due diligence on private equity managers, although this is not always the case and the bigger shops tend to be quite good, it does require us to go back to first principles, particularly on internal administration, and take a close look at who's doing what and the controls. Cash controls, again, that's often an area where it's perhaps not as well thought out, generally speaking, as on the hedge fund side. And that, again, is a very basic fraud prevention mechanism that one would want to look at. I don't see why one would take a different approach to that in private equity than hedge funds. And I think, thirdly, a reason kind of put forward for those not in favor of doing private equity operational due diligence that, well, once you're in, there's nothing you can do about it if something goes wrong. I think the corollary of that almost holds true. I mean, you're going into something where you know that your capital could potentially be locked up for something of the order of 10 years. That's a long time, and I think argues in favor of putting in the effort for ops due diligence on private equity.
Just to follow up on that, with regards to SEC registration, right, this is a big push or area in the private equity space as well as the hedge fund space. How are you approaching, and we touched on this briefly, Form PF filings, the issue of it, asking for it? We talked about testing and seeing how managers are doing. If you could just comment on your general thoughts on this area and sort of where we're going to be 6 months from now in terms of getting those documents, looking at them. Yeah.
We've not been big on looking at Form PFs, quite frankly, particularly from the operational side. It's got a lot of investment exposure on there, and we've sort of pushed that back to the investment team to consider at this point. But it's not that we are negatively. We view that it's not that we're sort of putting ourselves in a position where we're not going to potentially ask for it or look for it down the road. It's just that given our process, we think that it's probably more efficient for the investment teams at this point.
Yeah, I'm sorry.
No, I would second that, and I think that there's not enough detailed information on the Form PF that would be relevant to ascertain the operational issues that you could not yourself discover on a reasonable amount of effort, and get higher quality information, more timely information yourself. So I think that it's a mistake to rely on the Form PF disclosures when and if they occur.
One of the things I do find interesting, though, are the enhanced transparency reports from administrators that do have sort of the asset verification as well as the the level breakouts.
That
I find interesting.
I would definitely agree with that. I think from our perspective, really 2 points. One is that we've polled our managers in terms of asking a couple of questions. First of all, would you be willing to share the Form PF data, and have any investors asked for it? And I think 99% have said we wouldn't share it. If someone really wants to look at it, they can probably come on site and look through whatever 900 pages we have here. And most investors, again, have not asked for it. Personally, we don't plan to ask for the data. With 90 managers and the amount of information that's being put out, if the SEC can't handle it, my firm can't handle it. So we don't plan to ask for the data. And to your point, you're exactly right. I mean, the amount of good risk reports we get nowadays, directly from managers, also from the administrators in terms of transparency reports. We also have a risk aggregation platform that we subscribe to at our firm, so we get probably 60% of our managers send us portfolio information to these risk aggregation platforms. We find that more than enough for our needs, and in fact, we're told by our managers that we get better information than what is reported through Form PF anyway.
Yeah.
So what I'm hearing almost is as useless as Form ADV is, right, that it's almost better than Form PF because it's simpler, right, easier to digest.
Yeah, as I said before, relying on the SEC is relying on the kindness of strangers. It's not a good idea.
Sure. Except, right, when they're more aggressive, right?
Yeah, that's true. Aggressive strangers.
Aggressive strangers, right? Giving a hypothetical, right, in a topic we talked about earlier. Let's say you have a very well-established firm. You go in, you perform operational due diligence. They're in great shape. Next thing you know, the SEC shows up at the door and says, in 1990, you were insider trading, right? And, we have an employee, and they start to work their way up the chain, right? I'm just curious if you feel, and this relates to expert networks, from an operational due diligence perspective, is there really anything that you can do to sort of protect yourself from that, or it's sort of, it is what it is, and it goes so far back, and the SEC seems to go so far back. Yeah. It's a tough question. There's no right answer, but...
No, I agree. I mean, there's so many more variables than just sort of the question that's asked, and you kind of want to understand how it could impact the fund, if there's a fund expense related to it, clawback, whatever. But you're right. I mean, I don't think there's a right answer to that. It's all case by case.
And it's the reputational risk. Right?
Yeah, absolutely. And it's so tough from our perspectives because we have investors that come to us and say, well, what are you doing about insider trading? And, we're honest. There's not much we can do. We want to know that the manager has a good compliance program, that there is as many mitigating controls as it can be in terms of, compliance manual, code of ethics, training, even, monitoring, emails, things like that. So the more a manager does, the more comfort we get. But at the end of the day, something like that is just so hard to police from our perspective and from the hedge fund manager's perspective. You can't control, you can't control what people talk about. You can't control what they say after hours. The most you can do is have those controls in place and have your employees acknowledge it, and hopefully they won't do anything wrong.
I mean, there's so many mechanisms that could cause that information to exchange, but eventually it's just going to circle back and go so low tech that it's going to be a guy sliding a piece of paper across a parking garage to someone else. I mean, it's pretty much what it's going to come back to. I mean, you're never going to eliminate it, but can you find it? I don't know. I mean,
I think the most important thing too is, as a firm, and we've kind of been through this ourselves, is if you're involved with a manager that has been in the press or is charged with something, you have to have a good story to tell. You have to, investors want to know what you're going to do. You're going to redeem or you're not going to redeem. That's basically, and we unfortunately have come under this pressure. They just want to know, and there's various levels of pain threshold. There's investors, institutional investors that want nothing to do with it. They don't want the headline risk. And there's other investors, if they're doing well, hey, it's part of doing business,
My last point on this, too, is it's a mosaic, right? So you've got the operational aspect that everybody's sort of covering, but you also have the investment teams that's meeting with all of the analysts, the portfolio managers, trying to discern an edge, looking at the returns of the portfolio. And, there's ways to discover or identify risk factors through those mechanisms. So I think it's sort of a multi-tool approach to trying to work through that, but I don't think there's a right way to find it. I don't know if you guys agree.
That's true.
Yeah, no, I think those are all good points. And, some firms, I know some investors that take the perspective that they want funds not to work with expert networks, or they place a ban of 1 year on public companies, and that doesn't necessarily prevent it, right? So just to wrap up before we open it to questions, I'm curious, kind of 6 months going forward, a year going forward, what you think are going to be some of the issues or hot button issues. And we've talked about a lot of them already, but where are you focusing on going forward that you're not already covering, or that you anticipate putting more time and energy on, whether it's service providers, insider trading, regulatory issues, whoever just wants to go down the line?
Yeah, I think, service providers definitely, especially after hearing about some of the issues some have had in terms of their own infrastructure after, Hurricane Sandy and things like that. I think, we do perform due diligence on key service providers. So I think we'll focus more on that and really their own, BCP DR planning, which is something that we talk about, but we probably don't focus on too much. I think, the continued focus on regulation is always going to be an issue for a long time. I think someone mentioned earlier, the SEC always has different hot buttons. I think, valuations is going to be something that I've heard that's going to be, a hot button in the future in terms of just controls and valuation vis-a-vis, NAV strikes and performance fees and so forth. So I think that's going to be a big focus. So there's never going to be any shortage of regulatory issues to talk about.
I would agree with that. I think probably begin to continue to focus in the regulatory space, although things change all the time. Maybe something next week that causes us to focus on a different area. I think some of the more prominent cases relating to insider trading, where perhaps charges have not been brought, I think we'll be keeping an eye on that and seeing any lessons that come out of that either way. I think private equity is worth keeping an eye on as well. A lot in the regulatory space, SEC on record in terms of valuation and controls in private equity. I think we'd want to keep an eye on the news to see if anything happens over there and the lessons that we can learn from that.
Yeah, I agree. Private equity is certainly one area. For us and for me in particular, I think trading is a key area to focus on, particularly as more managers move to straight-through processing and increase their use of electronic trading, particularly in fixed income and derivatives, as well as brokerage commissions. Use of soft dollars. I think those are risky areas, and areas where you can actually add alpha and value by pushing back on the manager to be a little bit more transparent in those areas.
Correct. I mentioned before, I think the thing to watch is the IRS as the SEC is sort of stepping back a little bit from information disclosure on hedge fund area, the IRS is going to step forward, and there's going to be new and interesting developments in the next 6 months. Keep posted.
If I can just say, I think you raise a really good point on the trading side, because sometimes as ODD professionals, we sometimes don't look at the investment side of things and perhaps the impacts there. But, you know, my concern a little bit is on systematic traders, high-frequency traders, where there might be more regulation around those types of strategies. Limitations on things like dark pools, things like that.
Absolutely.
You know, that might have a huge impact on those types of strategies. So that's something we're focused on as well.
Absolutely.
Great. Great. Any questions? We'll open it up. Anyone? Sure. Yep.
Do you mind just outlining how your respective teams are structured, whether there's a split on the PE versus hedge fund side, and just how many people?
Sure. Just to repeat the question, it was sort of if the panels can outline the structure of their teams and if there's a split on the private equity or hedge fund side. Whoever wants to.
Just the number of people and the number of funds, hedge funds you expect to be.
Sure, ballpark resources, whatever detail you're comfortable with.
Yeah, so my firm, we don't deal in private equity, so I really have, quite honestly, no experience in private equity ODD, but our team focuses on, we have about 80 to 90 managers right now on our platform. There's a full-time ODD team of 3 people. But we run a hybrid model, meaning that while there's 3 ODD professionals responsible for ongoing and initial due diligence, service provider due diligence, we internally outsource some of the functions, so we have a separate accounting team that helps us look at audited financial statements, things like that. The only thing we do outsource to a third party is background checks, so we have a firm that does that for us. We have the help of our internal legal and compliance team that will look at ADVs and any regulatory filings. So while there's, you know, some people sometimes say, wow, it's a small team for so many funds, but we actually outsource internally a lot of different functions, and the ODD team is responsible for collating all that work and doing the on-site and essentially coming up with a final, you know, yay or nay decision on a particular manager.
I think you know, we do private equity, real estate, hedge funds, funds of funds. We do not dedicate certain people to certain types of those funds. It's just not efficient. Sometimes we may do more private equity than real estate, etc. So from a resource perspective, it generally hasn't been efficient for us to have people specialize. Secondly, I think having people do the work on different types of managers keeps the work challenging. I'm not sure that what you're looking at is significantly different from an operational perspective, that it requires a specialized, dedicated ODD resource. A lot of the first principles apply across types of funds, cash controls, external administration, etc. You know, as to numbers, I can speak to what I've seen across funds of funds generally, having covered them for a number of years. I think post-Madoff, obviously, there's been, you know, increased resources in the ODD space. At the time of Madoff, where we may have seen one senior analyst covering 50 to 60 managers per head as the kind of maximum high, that now tends to be around 40. Generally speaking, from my perspective, what I see is managers or ODD professionals having a caseload of between 20 to 40 managers that they cover. I think, though, you also need to consider in that what is your review interval. If you know, if one's reviewing that every 12 months, 40 managers may be very challenging for an analyst. Whereas if your review interval is 18 months, maybe 30 is doable. So you need to look at how frequently you're doing the ops due diligence and yeah.
Towers, we're all generalists, so we cover all the asset streams, and we all have different backgrounds to sort of accomplish that objective. We have 8 people dedicated on ops due diligence 100% of the time. We have one open headcount for one in New York and open headcount for one in London. Our global head is based in London. In terms of our universe, we're focused on operational due diligence for our discretionary business, so the pool of managers is a little bit tighter, but we're probably around, you know, the 200 manager range across all asset streams. Ultimately, we'd like to cover all of our top-rated managers, but that might take a bit of time, which would probably be around 600.
One issue I'd like to raise is to whom does the ODD report to within the organisation? If it reports at a low level, it may be perceived as just a marketing function. If it reports at a high level, then it's treated seriously.
We have an ODD steering committee at Towers Watson, so there are 3 people that are sort of responsible for the oversight of the team. The first person is head of operations in our EMEA region for the business. We have our chief compliance officer who's also involved, and a professional excellence officer who's also involved. So the oversight isn't so much on sort of the day-to-day stuff, but
Correct.
just dealing with the business issues and making sure that we have the right protocols in place.
Absolutely.
Yes, the same at my firm. We report to our head of research, but again, that's not really a day-to-day or really a,
Right.
you know, they really have no discretion in what we do or anything like
No,
that.
no,
We still
no.
have a right of veto. They don't have any right to override us or anything like that. So ultimately, our decision goes to our investment committee, but we report directly to head of research.
Right.
And I think we can all agree that as the scope of this work has increased, right, there's the number of resources hasn't sufficiently increased to
Correct.
support that. So it's always a balancing act, particularly when you have adding new managers and taking managers away. We have time for one more question. If anyone, yeah, sure.
What about open protocols? You guys adopting in the managers?
Yeah, I mean, open protocol, you're talking about the Alborn Opera,
Yes.
correct? That's more of an investment aspect, and yeah, our investment team certainly utilizes that as part of our risk assessment. For operational due diligence, it's not applicable.
Yeah, it's the same here. We have a separate risk team that's looking at that. So
Right.
I've been a little bit outside of that, but I believe similar answer from my perspective.
Great. I'd like to thank the panelists very much and everyone for attending. Good discussion. Thank you, everybody.